A couple different ways you can avoid private mortgage insurance. One, being a veteran, having a VA loan. Two, going with lender paid mortgage insurance. So even if you're putting less than 20% down, there's a way not to pay monthly mortgage insurance by taking a slightly higher rate, in turn, to not have to pay for mortgage insurance. And then there's also some upfront options where you can pay a large upfront fee called a buyout or upfront premium, where you pay one time so that way you don't have to pay it monthly. Typically, that makes sense if you think you'll have the home a while and you don't think values will go up very quickly. Most of the time in today's market, we do see that monthly mortgage insurance is a benefit to the consumer because it's something you can be taken off down the road. Mortgage insurance does exist to protect the lender. However, the benefit to the consumer is you're not stuck with a high rate for your entire loan. You can get rid of it down the line when you have more equity and you're a lower risk to the lender. A piggyback loan is a great creative way to avoid mortgage insurance. A piggyback loan is a loan where there's two loans in order to avoid mortgage insurance. So you have a first mortgage that has at least 20% down, and then you use the second mortgage to finance even more. Typically, the second mortgage or piggyback or HELOC, whatever you want to call it, is a higher rate. In some cases, even though it is a higher rate, it might make sense to do that versus paying mortgage insurance. In many cases, it might make sense to pay mortgage insurance versus looking at a piggyback. So everyone's situation is different. As a broker, it's great to have options, and these are options that brokers like us look at. Private mortgage insurance is based on many factors, including credit score, loan to value, aka your down payment, or how much you're financing. On a regular conventional loan, your mortgage insurance is actually set. On an FHA loan, one of the benefits of their mortgage insurance is that it actually does decrease every year based on the loan amount. Mortgage insurance gets a lot of bad press. A lot of people think mortgage insurance is going to be way more expensive than it is. Mortgage insurance, especially for consumers with higher credit scores, have gone down consistently the last several years as the risk for mortgages have gone down consistently over the last several years. So I would never let mortgage insurance alone stop anyone from buying a house. It's always worth it to look at buying versus renting, but you'd be surprised at some of the low costs of mortgage insurance out there. Mortgage insurance costs are based on several factors, the biggest being your credit score as well as your down payment. The more down payment you have and the better your credit is on a conventional loan, the cheaper your mortgage insurance is going to be. On an FHA loan, it's actually set for every credit score and only varies slightly if you put more than 5% down. So on a conventional loan, the better your credit, um, more down payment. Lots of times, depending on the lender, if you have two people on the loan versus one, that can also help your mortgage insurance costs. So comparing 20% versus 15% down for most lenders barely makes a difference and is less than 0.1% different in a rate.